back, everybody. Okay, quick questions or comments related to last week's talk. Kieran was talking about his work in terms of coming up with decision support tools. Anything about the city of Newburgh and its disastrous state of affairs? Anything else? No? All right. Does anybody have their own infrastructure news of the week? Anything come up? Chelsea? No?
She's thinking.
I had one. I didn't write it down. I know.
No, huh? All right. We actually couldn't find any either. But it turned out to be fine, because what we're going to do today, I'll just announce, we're going to actually end a little bit early. And if you're interested, Matt Kahn, who's from UCLA, is going to be talking about adapting to climate change, an economist's perspective. That's a talk being given over in AIM, I think somebody said. So at Dyson School.
401 Warren.
401 Warren at 4 o'clock, 4 to 5:30. So if anybody's interested in that, you know, some people in the room will be moving quickly over there when this is done. So we'll move through no infrastructure news of the week this week, and we'll end a little bit early. So that brings us to today's speaker, Rick Geddes. He's over in policy analysis and management, also director of Cornell Program in Infrastructure Policy, CPIP, and faculty in CPA, Cornell Institute for Public Affairs. And he'll be talking about public-private partnerships in the U.S. water sector.
Great.
All right.
Thanks, Brian.
Sure.
So one piece of infrastructure news, I don't know if you talked about it, but reconstruction on the third set of locks, the expansion of the Panama Canal, started up after a 2-month contract dispute between the government of Panama. And it's a pretty big piece of water infrastructure news. I don't know.
Yeah, that counts.
I'm saying that because we had, as Susan knows, we had the chief engineer of the new set of locks. The third set of locks, as the Panamanians say, is actually a Cornell grad in engineering from the class of 1974. He got his master's in '74. CPIP had him as a guest speaker in November down at the Cornell Club in New York City in a panel of discussants talking about the impacts of expanding the Panama Canal on trade. So I don't know if people follow these things, but Brian and I were just talking about dredging of harbors once they open that set of locks next year, I think. Ships are going to be 50 feet in depth that go through the Panama Canal, both directions, from Asia, say, up the East Coast. And we have to dredge the ports, like the Port of New York and New Jersey, Charleston, Port of Miami, Baltimore perhaps, to accommodate those huge ships that will be coming through. So that whole thing could be considered, I guess, a public-private partnership in the water sector in terms of reconstructing the canal. But I'm going to focus on the U.S. Pretty much. And just, I don't know where people are coming from in terms of backgrounds regarding public-private partnerships. So I'm going to assume that you don't have a lot of experience with this sort of new big thing, kind of policy innovation that is, the U.S. is frankly behind in the use of PPPs in a bunch of different sectors. Just a caveat, my main sector up until interacting with Susan Shreve and Brian has been in transportation. So I come at this from the perspective of using public-private partnerships and other types of innovative finance and the whole problems in the U.S. transportation sector. So by that I mean roads, bridges, tunnels, interstate highways, state roads, that whole ports to some extent, freight rail to a lesser extent, but much more of the transportation than the water side. So one of the things I'm very curious about exploring, and maybe others can help me, is how those models that have been used to provide innovative ways of funding and financing infrastructure in the transportation sector can be applied to the water sector. Brian, how long should I go before we go to Q&A?
It's up to you, but if you, I mean, it depends on when you want to get out of here.
What's the usual etiquette? Do you have people?
We usually go until about 4 o'clock.
But when do people ask questions as we go, or do they?
Usually people go way over their time. And
Okay, well, I'll try not to do that today. In deference to that.
Yeah,
But
usually
if you're-
people wait till the end to ask questions.
They wait till the end, but
Okay, okay.
leave as much time as you want.
Yeah, I mean, I guess in terms of this, I would probably rather ask questions as we go, I think.
Yeah.
Since my guess is it's new to people, so if there's something on a slide and you kind of get into this and you assume that people are familiar with some of the lingo, so if it's not clear, why don't you ask me as we go? So, you are probably all more familiar with the severe infrastructure challenge that the U.S. has in the water sector. And when I think of the water sector, I think of two main functions: providing clean drinking water and wastewater treatment. And that those systems generally consist of these three main components: pumps, plants, and pipes that have strong physical interconnections between those component parts, and they're highly dependent on each other. The other thing I've sort of gathered from my interactions here is that these challenges vary greatly across regions of the country, where the supply side of water is not a big issue in the Northeast, where we have plenty of rain and snow, etc., to keep our reservoirs full. But if you go out west, supply side scarcity of water in dry states becomes a much bigger area, reason for concern. And in the West, their infrastructure is relatively new, so newer compared to where we are in the Northeast, where those pumps, plants, and pipes are old, and many of them well past their original design lives. I understand there's some still wooden pipes in operation in the state of New York. Many of these pipes and mains are older than 100 years. The cost of repairing them, leakage, is a big issue. So, as in transportation in the U.S., as with regard to our interstates and our bridges and tunnels, massive investment needs is a serious challenge. So there's a big challenge in how do we supply the money that's necessary to renovate these systems that were built by our grandparents, and in some cases our great-grandparents, in order to keep these critical building blocks of society in operation. We just happen to be there's sort of this double whammy, if you will, of the investment needs being very high, at the same time that states and localities are fiscally strapped due to aging populations, healthcare needs, decline in state revenues because of lower sales taxes during the Great Recession, right? A lot of state income tax is also low as the economy went through its downturn. So people in these sectors, in transportation and in water, talk about the water infrastructure funding gap. So the difference between what the engineers say the needs are to either upgrade the system or just to maintain and operate the current system, and the available funding under current mechanisms, okay? So I just pulled, it's a bit dated, but it was US EPA Clean Water and Drinking Water Gap Analysis from 2002. I don't know if there's been a more recent update of this by the EPA, so keep in mind the age of this study. But even back in 2002, they were saying, over the next 20 years, the funding gap will grow to be $122 billion for clean water capital costs. So that's just the cost of replacing the pumps, plants, and pipes, and about $102 billion for drinking water capital, but also a gap for operation and maintenance, which is kind of surprising how large that is. But we're talking about these $500 billion, basically a big, big amount of money here. Anyway, this is sort of standard stuff that pops up in transportation, in roads and bridges and tunnels as well. This is ASCE's American Society of Civil Engineers. You might be familiar with their report card on infrastructure that they put out quadrennially. This came out, I think, in February, something like that. And I just happened now to look at the drinking water and wastewater treatment grades are low, D grade, out of A, B, C, D, etc. All this stuff is in pretty bad shape. And they say, basically drinking water pipes, replacement of drinking water pipes represent the largest single need out of that. We can talk about those ACE grades if you want. They're a trade association basically, but they do have some gravitas, I think, in doing that. So that's one of the basic context, at least for this region of the country, in thinking about why we need innovative policy and funding and financing approaches to address this. So I guess the next sequence in the discussion is to think about some terms that I guess one of our causes over in CPIP, and I'm working with a colleague, John Foote, on this and others, is to drive home the distinction between funding and financing, which has caused no end of confusion. So you see write-ups about public-private partnerships, and people say, we have a funding problem and PPPs can solve it. That statement is basically false, okay? PPPs have some benefits which I'll go through, but in some, you'll often see them overhyped, which I think is a concern. So one of the problems, just conceptual problems, is the difference between water infrastructure funding and water infrastructure financing. Okay, so if there's any single takeaway from this talk that I would like you to go out to the world and remember in these conversations, it is this distinction. Funding refers to how all this stuff, this $500 billion of upgrades, et cetera, is paid for. Where does the money come from to pay for it? As far as I can tell, there's only two sources. You either charge users directly for the water per gallon. You charge the households and factories and office buildings for their use of water, and you present them with a water bill, like my house, my wife and I pay our water bill quarterly or whatever it is, and on the bill it says how many gallons you used, and we're charged per gallon, right? So that's a user fee that we pay to the town of Ithaca, or the city, whatever it is, the village, I guess, for this, or, right, a non-user fee. But where does the money come from if users don't pay? It has to come out of the general tax revenue somehow. So, with some minor exceptions, the direct tax revenue, which may include grants from the state or the federal government, which is just a reallocation of tax revenue, or user fees, are the only funding sources. It's interesting to explore, I think, if PPPs could make the acceptance of user fees. Right? People don't want to pay for anything. They want stuff. They want clean water and all, but they don't want to pay for it. So one interesting question is, I think, how do you increase the acceptance of user fees in cases where people said, before my water was free. Of course it wasn't free. It was paid for somehow or other. It was just that you were not charged a direct user fee for it. And in transportation, by the way, that may be the #1 major policy issue that we're facing. As people drive Priuses, it's wonderful, but you don't pay for the roads because you're not burning fossil fuels, and the roads are paid for through fossil fuel taxes, right? So you got to switch to a system where they pay per lane mile of use, which people hate. Okay, but you got to switch to some new system. I think in water that would be a very interesting thing to research, and I just don't know enough about this sector. It would be fascinating to me to think about this mix of funding. The word financing is utterly abused in this context because people can say this is financing. No, this is how you pay for it is funding. Once the funding is in place, how you can use the capital markets to generate the money you need to renovate or build a new system, that's financing. The funding has to be in place first, and the financing is levered against the funding. So let me give you an example. If you have a stream of user fees, so the people in Ithaca are going to be paying per gallon of water, you're going to have this revenue coming in. You can say, hey, we know we have this revenue over the next 20, 30 years. We can raise municipal bonds, tax-exempt municipal bonds, and they're doing this right now, by the city of Ithaca, and the city of Ithaca goes out and they use a banker to sell the bonds to people who want, to be paid back principal plus some interest payment against, why would you lend that money? Because you expect the user fees to be paid over time. You expect the people in the city of Ithaca to continue to want to drink water and flush their toilets, etc. So that's one type of financing, tax-exempt muni bonds. So once you have the funding in place, there's a whole bunch of different creative ways you can use capital markets to give you the money you need now to renovate the system. And that's what's interesting. There's WIFIA, which is a extension of TIFIA, the Transportation Infrastructure Financing and Innovation Act. This would be the Water Infrastructure Financing and Innovation Act, would be a federal credit facility to help give low-cost loans for those types of systems.
Rick?
You can use taxable corporate bonds, state revolving funds, and private equity. Yeah.
Is WIFIA what they call an infrastructure bank?
No.
That's a different,
No. So there's stuff written about the difference between a bank and a fund.
okay.
Okay? And TIFIA is the transportation version of WIFIA, right?
Mhm.
It's run out of the U.S. Department of Transportation, and if you get, it used to be 65. So if you needed you were a state, you're a governor, and you want to do a major new transportation project in your state, and the language is it has to be a transportation project of national or regional significance.
Okay.
Okay? So it can't be like replacing guardrail, you know.
Yeah.
It has to be a big project. And it perhaps multi-state. If you can get like 65% of the financing, it costs a lot of money, right? In place to do that, you can go to the TIFIA credit facility and say, we have gotten private investors, we've got corporate bond financing, we've got maybe some state grants or whatever. We need the other 35% to complete this project of national and regional significance. Will you give us a low-cost loan? And they think about it and mull it over, and they say yes or no. And interestingly, the largest TIFIA loan was recently announced for the new Tappan Zee Bridge. Because it's hard to argue that's not a project of national and regional significance. Plus, the darn thing costs, I don't know what, $3.5 billion is the current estimate. It'll probably be more than that.
That should have been
Right.
our infrastructure news of the week, because as part of that agreement, they've got to map out the bathymetry of the Hudson.
The what?
So
The
topography of the riverbed
Oh, yeah.
below the water.
yeah.
Yeah.
So, which is why where the dredging and stuff becomes important too. 'Cause
Oh,
you wanna
yeah.
know where to dredge.
No, that's interesting. We had a woman who is a PhD in engineering speak in my class last semester, Martha Gross, who works at Arup, talk about how they're pounding in the pylons,
Yeah.
and they have these covers so that it doesn't hurt the fish. And it's a long story, but they're bubblers that prevent the impact of the hammer, basically, from hurting the fish. It actually killed the fish. It's very interesting. They got the biggest TIFIA loan in history. So WIFIA, which I think we've talked, Sri and I have talked a little bit about WIFIA, is kind of under discussion in the Senate. I don't know, I forget where that bill has gone. But the point that I want to emphasize is that once the funding is in place, you can get this, which is private companies taking equity positions actually in infrastructure projects. Okay, they put risk capital in, and we'll talk about why this is risky, and they expect a rate of return. And that's a key part of a public-private partnership. Not the only part, but that is a key part. So please, if you remember nothing else that I say, please try to remember this distinction. Are there any questions about funding versus financing? And it's enormous confusion. Yeah.
Could you give like a concrete example of it? I'm just trying to think of is funding more what's would pay for the ongoing maintenance, and the financing will help with these initial upfront costs to make some change?
So you've got to either have a commitment of user fees. So if anybody any investor, so you can have investors in tax-exempt muni bonds. You can have investors in taxable corporate bonds. You can have investors in equity, a government itself, right? They want to be paid back. And they want to be paid back at different rates. So if you're putting risk capital in for equity, you're expecting a higher rate of return. And we'll talk about, if we have time, why that is, than say a tax-exempt municipal bond investor. It doesn't matter, but they all want to be paid back with some sort of rate of return. Where is that paying back going to come from? As far as I can tell, only two sources: either people paying directly for the service, or the government committing tax money in advance to pay them back, right? And saying, and just promising, just saying, look, build, you know, we want to raise tax exempt muni bonds, and we promise that, you know, they're actually called GO bonds, general obligation bonds. And GO bonds just means we're going to tax everybody in Ithaca to pay those bonds back. There's a commitment from the government to do that. Or, in this infra world, they're revenue bonds. And in toll roads, they actually call, I don't know what it is for a water utility, but it's a toll revenue bond. So you build the Tappan Zee. It's going to be tolled, right? They haven't disclosed what the toll rates will be.
It's the same equivalent. You base it off of user fees. So you say that you will have projected user fees over a certain period of time.
Yeah.
So that's how you base revenue bonds.
Yes. What do they call? They don't call them toll bonds, though.
No, they just call them revenue bonds.
Just revenue bonds.
Yeah, just
okay,
revenue.
so it's just a revenue bond. But either way, so that a revenue bond would come out of user fees specific to the project, and direct tax revenue would pay off a general obligation bond. Do you see what I mean? So
Yeah, I think
it has to come from those two. Otherwise, the investors won't come near it. Even the muni bond investors won't, you know, aren't interested. Yeah.
Would another way of saying it be that the user fee has to cover not only paying back for the financing, but also the operation and maintenance?
Right.
So
Oh, yeah.
those are the two things that a user fee has to take care of.
So like the
Right.
initial, it'll pay back like the loan for the initial building of like a wastewater treatment plant upgrade,
Right.
but also continue to pay for the
Right.
maintenance of it.
And one thing Brian jogged my memory on, you know, there's something called a bond covenant. It's just a fancy word for a contract that the bondholders who are lending the money to build the thing or upgrade it or whatever demand before they'll give you their money. And in the bond covenant, it'll say, you must maintain your water system according to these, you know, these standards. And I don't know how strongly those things are enforced, but the bondholders have a real strong interest in keeping up, you know, the quality of the water system. It'd be a very interesting study to see how that works, because my sense is it hasn't worked that well. Susan?
Yeah, I think sometimes people get confused, Rick, too, because they think municipalities save up money to then build their plant. Almost
Save
like you
up
would,
money?
you know, like if you were gonna buy a car and you decide, I'm just gonna save my money and then I'm gonna go buy a car.
Yeah.
Whereas municipalities really aren't in a position to
No.
save $10 million and then build a wastewater treatment plant.
No.
So
They're
because they
balancing.
can't save money like that.
No, I think there's rules about that.
Yeah, there are rules, they're
I
not
mean,
allowed to do that.
They're basically not allowed to save in the way you're.
Right, but
So
I
they-
think sometimes people think about that, cause that's
Yeah,
how
you're
they,
right. How come they just didn't save
yeah,
the
why don't
money
they just
and-
save the
Yeah.
money and then build the plant?
Yeah, the city is subject to different rules than, say, your household.
Right.
Right?
And so
But-
they have to go out,
So they have to go to the bond market.
finance, they have to go
But
out
then
and
don't-
finance.
And the major, this has been the major, I think, I mean, that's another interesting question. My sense is that tax exempt muni bonds, which by the way, only the United States, as far as I can tell, is the only country on earth that allows the interest payments on the, you know, when you're the bondholder, you get paid interest.
Mhm.
At the federal level, they're tax exempt. Do you see what I mean?
Right.
That's why I'm calling them tax exempt municipal bonds, because if you buy one of these Ithaca water bonds, you're paid back by Ithaca, right, with interest, and that interest income is not taxed at the federal level. I've asked around, there's a whole book on the history of how this, it was President Roosevelt versus some guy from the Hudson Valley. But anyway, we ended up with this, and we can talk about the effect of that. But that has been the major funding financing device for these, they both start with that. Yeah, for these, you know, these kinds of, these pieces of infrastructure, yeah.
That was actually gonna be my question of that list, you know, is a major city gonna get more private investment versus, I'm most familiar with being asked, you know, at election time, do I approve of
Right.
tax exempt bonds to
Right.
fund whatever project, so I'm familiar with those existing, but
Right.
if New York City upgrades its water infrastructure, does it normally do through bonds, or does it actually draw on some of these other sources?
No, I mean, it's the vast, you know, again, I'd love to get the real numbers, but my sense is that the vast majority of the financing comes from tax exempt muni bonds. And it's a multi-trillion-dollar market. In these things, there are people who dedicate their entire careers to rating and buying and selling just those muni bonds. But I will tell you, there have been proposals to eliminate that tax exemption by the Obama administration. and by others. And the spreads, what we call the spreads between the tax-exempt muni bond interest rate and the taxable corporates is narrowing. Because the bond markets are viewing cities as more and more risky. And states, too, right? I mean, you've got the bankruptcy of Detroit, you've got the bankruptcy of Stockton, California, Vallejo, a whole bunch of city bankruptcies. And the bond markets are saying, hey, wait a minute, just because you have taxing power doesn't mean my bond is that safe. So we're seeing the interest rates, the cost of money, right, getting closer between the two. So I'm predicting right now that they're going to start using more of these other financing approaches. But up to this point, tax-exempt muni bonds have been the #1 way of doing that.
Because they just have such an advantage.
It's just such a lower, it's cheap
Yeah.
money,
Yeah.
a couple %. And you could go online, anybody online could go to the TIFIA, today's TIFIA loan rate. It's on their webpage for the DOT, and it's like 3% or something. Whatever it is, it's daily.
It strikes me that this is almost exactly like buying a house, and then like, you don't pay $150,000. I mean, some people can, but like, you don't just walk up and pay $150,000. Like, the bank pays it, and then you take a mortgage with the bank.
Sure.
So the bank is financing it. And the funding is your paycheck that you use
Perfect.
for paying your mortgage.
I love that,
So
and they will not give
funding is your paycheck.
the
won't give you
bank will not give you
financing.
the loan until
Right.
they look at your paycheck.
Right.
And then they
They
say,
want to make sure you can fund it.
exactly. So that's a great example. Yes, Ms.
Using that example then, the word capital markets in there, is financing, not, I guess, you don't have any, you're not getting loans, are you, or?
When I say capital markets, I just mean the market for money.
Okay.
So you need a big, to renovate Ithaca's water system or sewer system, you need a big blob of money, right? And the city, like Susan said, the city doesn't have it. So you gotta go to the money, to either the bond markets, and there's different types of bonds, or to the feds, right? And the feds in water have not been very helpful, or there's these state revolving funds, which I'd like to study more in the water context. And then, which I do understand a little bit, are the private investor market. So private investors are dying. I mean, there's billions of dollars around the world that would love to invest in the US water sector, right? And to actually take risk position, actually take an equity stake in it. Versus, we don't have a lot of time to get into the difference between debt and equity. But if you take an equity stake, there's no promise you're going to be paid back, right? There's no guarantee. You don't have the right to move that entity into bankruptcy to pay you back. One thing any bondholder has is the right to force that thing into bankruptcy to pay them back. Bondholders are brutal that way, right? Because they want to be paid back more than anything else. And they literally have the right to force the city into bankruptcy. We talk about selling the art museum in Detroit. That's how severe it gets. So if they're corporate, well, anyway, I don't want to get, but equity, you take an equity investment, you give the money, the capital money, but you don't have a covenant or a contract that says we will pay you back against this. You're just taking the risk that after all the other expenses, there's something left over from the user fees that you have a right to that will compensate you for the risk you took.
So I'm interested, why then would private industry invest? Why would there become public-private partnerships? I'm excited.
Great, because it's such a safe investment, right? Because people are going to drink water. People are going to flush the toilets. Regardless of, the global economy will go up and down, but people will shower. Right? I mean, think about it, right? And so if you're charging per gallon, and you're a pension fund manager. You manage one of my favorites, the Ontario Teachers Pension Fund. You have a responsibility. Your job is to make sure that there's money there when those teachers retire in 20 or 30 years to take care of them in their retirement. That's a heavy responsibility. You have a fiduciary duty to them. What do you invest in to make sure that those teachers 30 years from now will have money in their retirement funds? That's the job of a public pension fund manager. And you're saying, wow, if I invest in Apple, maybe it'll blow up in the next, there'll be some competitor, some new thing. Boy, that's not very secure. A toll road, That sounds good. Electricity? That sounds good. Water? That sounds even better, right? But you don't want a bond that pays you 2 or 3%, because you might have to make 6%. That might be your target in order to make sure those teachers have that money in the account when they retire. Do you see what I mean? So you're looking at an equity position. And that's why you would love to do a PPP in water. And it turns out that even toll roads are not as, the revenue is not as stable. It's much more sensitive to the economy than we thought. Because if people don't have jobs, they don't drive as much, they don't shop as much. But water is a really secure investment. Does that?
So yeah, so you're saying in each sort of industry, the decision between bond and equity is different.
Absolutely. And across regions and across a whole bunch of things. But overall, I can tell you that there are sovereign wealth funds in the Middle East and Asia that are dying to invest in the U.S. water sector. Because we have a strong economy. People are still going to be able to pay their water bills, right? It's not a question of, your question to me suggested, are there people who want to invest? There are huge funds that would love to invest, they just don't have the deals. The problem is the supply of good investments to meet that demand. Does that make sense? Good, so that's my, all right. Definition. My favorite definition is from the U.S. Federal Highway Administration about public-private partnerships, just contractual agreements between a public agency, I like to think of that as the public project sponsor the project, and a private sector entity that allow for greater private sector participation. That's with roads, right? But what I want you to think about with a PPP is a contract. And contracts are infinitely versatile. You can do all sorts of, different ways of structuring the contract. And again, it offers a new way of financing, but it doesn't offer new funding. I want you to get some of the lingo down. So number 2 to remember would be the difference between, and again, it'd be interesting to think about this in the water context, a brownfield versus a greenfield PPP. And these terms, again, come out of transportation. A brownfield P3 is an existing built system, okay? And you lease out, through a concession agreement, the operation, maintenance, renovation, whatever functions you want, billing, right? Meters, installing meters, etc., to a private company for a set period of time through the PPP contract. And if it's already built, it's a brownfield. A greenfield PPP inherently involves more private sector participation because the thing's not built. So suppose you have a new growth area in California or something, and they don't have water, and you need the system built, then you could use a greenfield P3 to contract. It could be with multiple firms, it could be one giant contract with a single firm. And I'll talk about the contract types in a second. This would be a DBFOM, design, build, finance, operate, maintain. All in one, and they do it, and it's a new system, okay? And if it's a new system, that's a greenfield. It's just, is there some confusion, some overlap between the two? If you really have to renovate a whole new system, so you have to dig the whole thing out and completely redesign? Yes, there's a little bit of gray areas, but basically those are the terms for the two main ones. All right, I want to suggest, so that's the first thing, brownfield versus greenfield, yes.
So you talked about the difference between funding and financing, but in your, at least the greenfield scheme,
This one?
would not that private partner be able to set prices?
Ah, yeah,
So-
uh-huh.
Do they control future funding, basically, through their?
The revenue, yes, absolutely. So the setting of water rates is a really big issue, right? But that's true, so keep in mind that's true in electricity. So over half of the boilerplate U.S. generating capacity is provided by investor-owned utilities. You could go out this afternoon and buy a share of, Pacific Gas and Electric or something like that. So we're all concerned about price gouging for electricity. So my point is that those issues, which I'll get to in a little bit, have been the source of concern in economics for decades. How do you set the prices right? You know, this is a utility, right? It's a utility. So it's what you've suggested is the whole issue of public utility pricing. And I can talk a little bit about that, but absolutely. So when I said the distinction between financing and funding, I meant more the source, right? If there's a price, it's a user fee. So what your question suggested is we're in a user fee world, not a tax payment world. Does that make sense? Okay, so I want to get this on the table. More terminology. I'm using the word real toll here, borrowed from transportation. I want you to think of two broad payment schemes that you could use to compensate the private sector for putting in their capital and taking your risk, okay? One is called an availability payment scheme, and this can be done with either tax revenue or user fees. The basic idea is the government collects the tax revenue or collects the user fee revenue, and then it observes what the private sector partner does when it operates the water utility. Do you provide clean water? We're going to test. Is the pressure in the pipes what we want it to be? We're going to test. How much volume of water do you make available, right? I don't know if outages are an issue. You know, they are in electricity, obviously, particularly around here when a tree hits a power line. But in water, you know, probably less so. But that could be another aspect of your performance measure. And we're going to compensate you based on your performance. And we're going to write that into the contract. If you do well, you know, you get these extra payments. If you do poorly, the water pressure is low, water quality is low, etc., we're going to penalize you. So that would be an availability payment scheme. That, in the transportation world, has been used a lot by the Brits. The United Kingdom has used a lot of availability payment, PPPs on roads, where they didn't want to toll it, but they wanted to use a PPP, okay? Now I'm calling it a real toll. I just made that up because it's like transportation. We have to come up with some good term for water. But real toll means that you would charge a price per gallon to the households and the businesses, and the private partner directly takes control of the revenue. They have a right in the contract to collect the revenue and bill people. See the difference? And then in the contract they provide services of a certain quality and they get penalized. So I want you to think about those two broad types of compensation or payment schemes within a PPP. And another misconception that I've battled for a long time is the notion that people say, well, you can't use a PPP unless it's profitable because the private sector won't come in. It's false, okay? You can still use subsidies in either one of these schemes, right? The private sector is not going to come in and take a loss, but you can still get the benefits that I'll articulate in a second of using a PPP, even if the system loses money. And you don't, for whatever social reason, say you don't want to charge households much per gallon, you want to subsidize your water system, right? You can imagine some scenarios. You can still use the P3 approach. That's the point of this bullet on here. All right? I'm happy to go into that in more detail. Let me quickly go through some basic P3 contractual types. So PPP is a fancy, sexy word for contract. Okay? Detailed, complicated, performance-based contract, but it's still a contract. And there's a whole bunch of different types. The end-to-end P3 contract, the sort of gold standard, is the DBFOM. So the private sector designs, builds, finances, operates, and maintains the whole thing. So this is like the city saying, here, right? You guys, you come up with the design, you tell us the design, you construct it, you maintain it, you operate it, you finance it. Here. It's like just one step short of just selling the whole thing. It's not selling, because title to the asset still remains with the city, with the public sector, okay? But the private sector takes a whole bunch of responsibilities. We've seen a lot of DBFOMs, some DBFOMs in roads. And then you can have these other innovations. A bot is a big one. China does a lot of bot contracts in roads, I recently discovered. So that's build, operate, transfer. So the private sector will design and build the thing, operate the road for a while, actually hold title until it transfers at the end of some concession period. The thing is probably tolled, and that compensates the private sector for doing those things, and then it transfers it back to the public sector. And then there's build, transfer, operate. I'm not too familiar with the difference there, but the title, after the construction period, title would transfer back to the public sector from the private, but the private sector would still continue to operate. That's the O in the BTO. Okay. Then I didn't have in here, but the most common is just a DB, is a design build, okay? And that means the same firm designs and builds the thing. Can anybody throw out why you might want the same company to design your piece of infrastructure as constructs it?
I worked on a design build project on a highway, and
You did? Great.
yeah, and every time that we needed to make a change because there was some mistake, someone put the wrong concrete in,
Right.
you could go back to the engineers who designed it, and they would make sure that
Yeah.
that was acceptable change to make in the design, and it would go back out. So it shortened the construction process.
So are the engineers who designed it across the hall?
Yeah,
So they're in
essentially.
the same company,
Essentially.
right? Essentially.
It was two different companies, but they partnered very closely.
But they partnered closely in the design. So it makes like change orders, and it makes those synergies, if you will, easier to exploit, I think. So I think it was within the past 6 months. The state of New York is like in the Middle Ages, basically. They just passed design build legislation at the state that would allow you to do a DB PPP, okay? And of course other states have allowed DBFOMs, and 33 states have passed, 33 US states have passed really pretty strong PPP enabling legislation, which we've studied over in PAM, that to facilitate this. So even New York State is slowly moving along with DBs, and they did that because they wanted to do, I think, the Tappan Zee as a design build bridge, okay, which, I personally believe huge social benefits from those synergies. So I didn't put DBs up on this slide. I just wanted to throw out a LTL, long-term lease, or concession agreement, sometimes called, where you concession out this would obviously be for brownfield. So the system is already built, in this case a brownfield P3, and you then say, okay, we're going to just lease out the operation of this. In roads, there's been 4 big ones. The 2 big ones were the Chicago Skyway, south of Chicago, going into Gary, Indiana, was concessioned by the city out to a private operator for $1.6 billion. And the Indiana Toll Road runs along the northern end of Indiana by Governor Mitch Daniels, was leased out. This was prior to the 2008 financial crisis, for $12 billion, I think. Governor Rendell, when Governor Rendell was governor of Pennsylvania, he almost leased the entire Pennsylvania Turnpike in a concession agreement to a private operator that would have given the state, maybe that was the $13 billion that was offered by a Spanish operator and an Australian investment bank together. About $13 billion that would have gone into the state's pension fund. And I don't know if people know, but the state of Pennsylvania pension fund has done a very good job of investing their money. They get a very high rate of return. And Governor Rendell proposed using the income from the investments to renovate stuff, transportation stuff, around the state of Pennsylvania. And at the very last minute, because I don't know if Governor Rendell is a very hard-charging kind of person, not a good communicator, and he didn't communicate well with the legislature. And they put the kibosh on his. But anyway, that was a transportation example. Again, I'd love to learn more about this in the water sector, but at least have this concession or long-term lease contract model in your head, because it's a very interesting one. Okay, yes?
What sort of protections would be included in a real toll PPP to make sure that prices aren't pushed up sky
Yeah.
high?
So if you want to, if you can hang on a couple slides, we'll get to that after this. I agree, that's great. I just wanted to tell you some sites you may not be aware of. 2 big companies in the U.S. that are doing this already. Perhaps the biggest is United Water, that I just learned in fixing up the slide, has partnered with Suez. Suez Canal, French, right? Suez is a giant old French water company, you know, the French water that you drink in the bubble. Anyway, it goes beyond just the bottled water. The French have been involved in the water industry for centuries. And Veolia is even older than Suez. Check out the site, just check out Veolia Water and you'll see what I'm talking about. I just pulled this link from United Water, which is interesting because there's
They're all
a
the same
link for
company.
PPPs. I'm sorry?
They're all the same company.
Is Veolia and United?
Veolia bought United Water, Suez bought Veolia. They're all connected because the French government has a stake in Suez, but they also
So
they,
there's
that
like
to-
one big one?
it's
or-
one big company.
Okay, so take this out, don't steal. It's the same thing. I couldn't find anything about.
They
PPPs
don't
on the
claim
site.
that. If you go to the United Water website, they don't say Suez, but their logo has both.
No, if you go to United Water, there's a Suez
Suez logo, yeah.
Yeah, well,
okay.
they own, Suez owns United Water, right?
Right.
So,
But does Veolia own?
There is some connection.
I thought Veolia was separate.
Okay. So this whole industry is a giant incestuous kind of thing. But anyway, the interesting thing here is UnitedWater.com has a PPP link, right? So there's a link there that'll tell you more about, you know, and these are, notice these things are in quotes. They're from the United Water site. So they're on to what I'm talking about. And it says, you know, contractual agreements that enable municipalities to outsource management and operation of their water and wastewater systems. Risks, rewards, and resources are shared, providing greater efficiencies, hopefully. Better access to capital, that's what I was saying about alternative types of financing, and improved compliance with government oversight. That's in the contract. I have come to the conclusion that one of the best things about P3s is you can write stuff clearly in the contract, and you can say, if you don't do this, you will pay X, right? You'll pay $1 million a week, or whatever the number is, to make them comply. So that, because they're profit maximizing companies, they have these really strong incentives to avoid that $1 million a week payment. And I was also impressed to see that nearly half of all water systems in the US, I think this word is wrong. I don't think they're privately owned. I think they're operated.
Right.
But I think the title, the legal title to the system, still rests with the public sector. So it should probably say privately managed or operated, something like that. Anyway, shared ownership, another interesting question for research, I think, in the policy area. So that's just some examples. Any questions thus far on? Yes, Miss.
So, there's been some talk in Detroit of privatizing the water system. Would that be similar to a PPP, or is it
Yeah.
not because you just removed the public from
So,
it?
so unless there's been a development recently, my understanding of the proposal is it's not privatization.
Okay.
It's to share it with other counties.
There's-
It would all be public.
Yeah, there's that, and then there's also they're investigating privatization.
They
as
are,
the other
okay.
option.
Well, you know more than I do. Are they, but what form? A sale, a lease?
I don't know too much about it. I've just heard. I'm
Yeah.
from Michigan, so I've heard rumblings of it.
Okay,
Um,
okay.
But because there's resistance from the counties to
Yeah.
sharing the water system.
I heard about the sharing with the other counties that are nearby and sort of consolidating, and I think that might have some potential. I think when you go out and you say, you know, you go on to the media and you say, we're gonna sell the water system, okay? That causes a reaction, you know, in people.
It's like selling the Pennsylvania terminal.
It's right. So I don't know, but you know, if it's a lease, you know, for maybe short periods of time in this world, or 15, 20 years, okay, that would be a short-term lease. That might be, you know, perfectly reasonable thing to do. The city would get an upfront payment, wouldn't have to sell the ark. That's the kind of situation that Detroit is in, and if it's not the last city, by the way. Okay, so I wanted to say, hopefully get a few things on the table about why you would do this, okay? So people, part of this is personal, because everybody says, Rick, just use tax-exempt municipal bonds, because they're cheap. You don't have to pay much money to get them, you don't have to pay much interest to get the money. And I'm like, wait a minute, there's other reasons. First of all, that's distorted by the tax code. And second of all, there's other reasons, you know, to do this. So, let me just articulate those. Hopefully you take away. Why do a P3 in water? Access to new types of financial markets, basically. Oftentimes these, in terms of equity stakes, public and private pension funds and insurance companies love these types of investments. They're dying to get into it because they have liabilities they have to meet in the future. Think if you're an insurance company, your life insurance company, people die that you have to pay off. You have this future liabilities stream to pay off. You can match those liabilities with the cash flow from a water utility. It's a nice investment, right? And this is not Gordon Gekko, right? These are patient, you know, people investing for 10, 20, 30 years out, very conservative, very careful investors, all right? Privately issued corporate bonds, you get access to a whole new type of bond market. But one of the things, another issue of, there's so much confusion in this, it's kind of shocking, is about what's called risk transfer. All of this is risky. And let me just scoot ahead here to think about things that could go wrong if you're doing a DBFOM on a water system. Your job is to build, design, build, maintain the system, finance, right? What could possibly go wrong? Well, your design could be screwed up. There could be something that's wrong in the design. Maybe for water, I don't know, maybe that's not a big risk. But I know things happen during construction all the time. Stuff happens, and it's often not good. Still, I'm always shocked when I talk to sort of geophysics people about how if you tunnel under the Hudson, they really can't tell you what you might hit. They have these thumping technologies, it's like sonar, but they still can't tell. There's still geotechnical risks anytime you're digging in the ground. And that could cost you a lot of money. Operational risks, like I don't know if people followed the gas main blow in Harlem that killed 7 people. They think that may have been linked to a leaky water pipe in the street that was sort of slowly digging out.
We talked about that.
Did you talk about this?
That was one of our-
I mean, I'm thinking, my gosh, you know, talk about interactions between
Yeah.
the sectors, right? That's kind of a dramatic example of an operational risk. They're probably, but you know, these water mains are breaking all the time. A big risk is whether you're going to get the environmental permits to do that, whether or not the EPA or is going to stop you, the state or federal. And then what I like to call the takings risk is that in the contract you agree to one set of, and this gets back to your questions about the rates. You agree to one set of water rates, and then say there's a new election and a person comes in who says, you know, this terrible PPP we signed, we should cut the rates in half. And then I call that a takings kind of, because it's called a regulatory takings. There's a big sort of body of law on this. But all of those pale, I think, in comparison to this one, the big one. And that is, if you're actually doing a DBFOM, we'll call it a real toll water PPP, you're taking the risk of how much people will pay you. How much water are they going to use? Suppose there's a big push around the country to don't take showers, or because don't waste water, whatever it is. That's great, maybe that's good from an environmental perspective, but if you're the private PPP, that lowers your revenue because the demand or revenue or market risk, it's all the same, reduces your revenue. And you could be in deep doo-doo, even in something as, quote, safe as water.
Yeah, you know, Rick, one thing I was just gonna say, because people bring that up and they say, oh yeah, then it's a private investors don't wanna invest, but it's also, even if it's publicly owned, you still have that problem. Because
Oh,
you've
sure.
invested all this money and then people aren't
Absolutely.
gonna use as much water, you can't pay all your people and pay back the loans and so on.
So Susan, that's why I have this, I have this number 2 here,
Yeah,
is that people think if you transfer the risk to the private sector, the risk goes away.
yeah,
It doesn't.
Yeah.
The private sector wants to be compensated for taking the risk. They price the risk into the deal.
yeah.
The question for PPPs is which party is better at managing and controlling that set of risks,
Yeah.
right? Maybe the private sector, I don't know, is better at forecasting demand than the city of Ithaca. Maybe the city of Ithaca is better at getting the permits. Do you know what I mean?
Yeah.
So a PPP is about writing a nice contract that the contract allocates these risks to one party or the other. It will say, if we hit a giant granite deposit and we can't put the pipes in, then we take that risk, right? And we're just going to give you a price of a contract taking that risk into account. Or we don't take that risk. The city has to compensate us for the extra cost of going through the granite. Do you see what I mean? So the P3 contract is really all about risk allocation and getting that right. And in an economic sense, getting that right is allocating it to whichever party is better at managing the risk, right? So that's kind of a thing. Any questions on this? So it's not a free lunch. People say, transfer risk to the private sector. But the private sector is not going to take on that risk for free. If you tell them you have to tunnel through granite, they're going to try to price that expected loss into the contract. Does everybody see this? So anyway, one of the big things, I talk to road engineers who are almost in tears on, you know, because of the roads in their county are so terrible, and they're trained to, you know, professionally to keep those things up. And one of the things I hear from them is that they like most is that through a P3 contract you can actually enforce a clearly specified maintenance schedule with penalties and rewards for violating what the engineers tell you is the optimal maintenance schedule. Okay, so I've come to believe that number two, why do water P3s? At least in roads it's important, and again I would love to learn more about the water sector. But I also know that technology and all of this stuff is moving forward blindingly fast. And there's new technologies. You can go to these conferences and it's like Star Trek. Like you can't believe the stuff that they've come up with. Just the other day, glow-in-the-dark paint for roads. Why haven't we had that for years? It's just that goop, you know, that absorbs the sun. And then at night, you can get that stuff, it'll glow all night. Just from a sunny day. They're doing it in Norway. So glow-in-the-dark road paint. But think of sensors, pour concrete. There's a guy right here on campus who's the expert in that. Tiny sensors that you pour in the concrete that will read out 12 different chemical properties of the concrete if you put a reader over them. Okay, and they're embedded in the infrastructure. Why would you do that? Because it will tell you when to replace certain sections and not others. So you don't have to tear up the whole system when it deteriorates. You just, you know, patch it up. That's high-tech stuff. People don't appreciate the interaction between a P3 and technology adoption, because I think a lot of people don't appreciate that you could write that into the contract and say, you must use the best available current technology, defined somehow, in any construction or renovations. You also can include global experts, like Veolia and others. You also allow for competition, right, which economists like, you know, to think about competition coming in. I've stressed on the investor side, which people often forget. You know, these are not rapacious capitalists. These are people trying to provide for the pensioners 20, 30 years down the road. P3 creates those new investment opportunities for them. And finally, in some cases, we want high-powered incentives. Don't have time, but the economics profession is now pretty well settled on what types of activities we want the firm to be focused on profit maximization, and what cases where we don't. Just the short answer is, in cases where we can monitor the quality of contract compliance, where you can easily see what they're doing, high-powered incentives can be socially beneficial. So there's 7 reasons at least for why doing these. But there's a bunch of concerns, and this is the concern about rates, okay? On both sides of the project there are concerns. On the private partner side, is what we call opportunism. There's a big problem with water, road, electricity investment. It is sunk, irreversible investment, okay? Once you put in a water system, you can't take it back. And there's no alternative use. It can only be used as a water system, right? There's a whole literature. A guy won a Nobel Prize, Oliver O. Williamson, for his work on contracting, sunk investments, and opportunism. And the private partners need assurances, because the stuff lasts 30 years, they need assurances that they're going to get their rate of return back over time. And so they write things like, we can't go into the details of the contracts, but things like non-compete clauses in the contracts, property rights and contract enforcement is obviously important. So there's a partner side, but then the public side. And that's the public welfare from all this. And my shtick has been that we can learn from other industries, other utilities, where pricing is a concern, whether they're going to charge monopoly prices. Nobody wants that. And we can show, you know, mathematically that that'll cause a social loss. So we have toll or price caps And there's a whole literature that we can borrow from other sectors to apply in water and in transportation. The second concern, of course, is quality of service, which is huge in water because you don't want to contaminate it and you want the wastewater to be treated properly. So quality of service is an issue in electricity. How strong are the lights? How often do the lights go out, right? So the reliability of the lights. Access, so there's what's called common carrier rules, where if you want to locate a business here in Tompkins County, I guess Commonwealth Edison has a duty to hook you up to the system. They can't say no to you. They must serve you. Common carrier, the same would be true of water, right? The same is true for other utilities, right? And of course the maintenance of the assets. And these are public assets in some sense, and we don't want a private operator to just run down, not maintain the asset, and then say, here, I'm handing it back to you, it's a piece of junk, all right? So does that address the questions about rates? And it's not just rates, right? There are these whole sets of utility, concerns, quality of service. In the old days, it used to be one in telecom. You pick, this doesn't matter, I think telecom has changed so much. You would used to pick up the phone and you'd have the line. How many seconds did it take before you got a dial tone? That would be a quality of service in telecom. It's the same in a lot of utilities. Any questions about that? Because I know that's a big sort of utility concern. Risk transfer we talked about, and I said in answer to Susan that what types of risks can be borne by each party at least cost is the key question. These next couple slides are focused on the investor side. I guess a little bit of a plug for infrastructure is what they call an alternative investment. I'll just get the language out there. Alternatives means alternatives to stocks and bonds, basically. Okay? So alternative, the big, real estate used to be the big alternative investment class. So you know that you can invest in Apple, you can invest in Microsoft, you can invest in Google, et cetera, and then you can buy bonds. Okay, those are the two big markets. But infrastructure offers you this new type of opportunity, toll roads, water systems, airports, et cetera, that behave differently and will give you added diversification to your portfolio if it's Shree's job to be the investment manager for the Ontario Teachers Pension Fund, or the California CalPERS, the California Public Employees Retirement System. It's a big problem you have, right? So you love diversification. You don't want that fund to be tapped out when all those people retire. So that's what this, these final things are. I'm happy to talk more about that. These are different ways of investing in P3s. How you, not every investor is capable of buying a water, I should say, or doing a DBFOM for a water system. So you have to have intermediaries who, you could do it. Actually, one of my favorites is the Dallas Firemen's Pension Fund. Okay, so this Dallas, big town, a lot of firemen and firewomen, I guess, who pay into the pension fund. They want the money to be there when they retire. The pension fund itself bought a toll road. I thought that was interesting. They didn't go through Wall Street. They didn't call up some intermediary. They bought the damn toll road themselves. And they said, we're going to manage it, ourselves. Okay, that would be an example of direct P3 participation. But not every pension fund wants to get into the business of running a toll road. Or you can imagine the problems that come up, right? So listed P3 funds, these funds are now listed on, you can buy shares, basically. It becomes more like a stock, a regular stock at that point, and we can talk about why that is. And then there's unlisted P3 funds. This whole sector is, I think, tremendously exciting because the room for financial innovation, and say create a P3 index fund. So you just buy the index, and the index behaves like a set of infrastructure investments, right? You could do that. I'm predicting in the future you're going to see that. So all these different vehicles for investments are just like that. Yeah, these are kind of old. But anyway, I should probably stop there because we're we're out of time, but questions, follow-up questions, Sri?
In terms of monitoring, you had two different types. One is where the government agency, the public agency, does the monitoring, and the other one where the private partner does the
What
monitoring
monitoring of?
of a product, so water quality, so some kind of outcome.
Okay. Yep.
Does that so in terms of New York State context, where a lot of it is locally controlled, locally designed, locally monitored. So if you were to replace a local water district, let's say, with a private company, how do you fit that in with the existing paradigm, where the private company itself is responsible for monitoring its own water quality? I'm just trying to figure out how do you fit that into the current system, and do you have to change anything?
Yes, I hope I didn't imply that the private partner would be monitoring itself. Because
But it's in the okay, so somebody else does it, but it's in the contract.
Well, yeah, I mean, so you could have a third party, and I would actually predict that you would see engineering firms evolve that would specialize in monitoring P3 behavior, and they would report back to the public sector, these guys are in violation, or these guys are doing great, or whatever it is, right? But you wouldn't want a conflict of interest.
Right.
To arise. You would want some hopefully objective third party. But Sri, that gets to actually a really great broader issue. And the U.S. is so far behind in this, it's awful. There are these things that many governments have created called PPP units. And a PPP unit is a part of government typically, or some like independent agency, whose job it is to educate public sector people about don't sign a contract that's gonna, cause trouble down the road. Here's what a good contract looks like, and they help monitor. So the leaders in this are the Canadians. British Columbia has its own, you can look at it now, Partnerships BC, and Ontario has it, right? They have these different P3 units that have the responsibility for helping out with all this contract monitoring, setting up the contract, all this stuff. And the U.S. has been in trouble, like the city of Chicago signs this contract for 99 years lease of the Chicago Skyway, doesn't have any entity, any unit within the government of the city of Chicago to monitor the contract. They have no bloody idea of whether the private concessionaire is upholding and how are they going to enforce it if they don't? Do you see what I mean? So really a bad, you really need these are long-term contracts. I think 99 years is too long. The Indiana Toll Road was 75 years. I think that's too long. But even if it's 30 years, you still need some P3 unit to monitor the contract over time. We're talking about a really new model for the delivery of a lot of infrastructure. Yeah, Susan.
One other thing I read what some of the Brits were talking about, and it goes back to this issue of conservation, and if you're charging a certain rate for consumption, if anything, who's ever delivering it, whether it's the public or the private sector, wants to encourage, if anything, more consumption, because that's their revenue if you're being charged per gallon of water you use. So that's kind of going against the conservation grain, and so they were suggesting instead of being charged a fee based on the amount of water you use, that you would have a contractor deliver, charge a household for kind of water service delivery. So and then that could incentivize those contractors to get people to save water. They would get a certain amount, $1,000 per year per household. And if the less water they use.
Oh, I see.
And so they would incentivize.
They save money.
They save money, and so they would then incentivize people using water-saving devices.
Yes.
All that kind of stuff. So you could accomplish conservation using that kind of model as opposed to which I thought was really interesting.
But see, one of my points, Susan, is that I think this model can help facilitate that.
Yeah.
In other words, because what this forces you to think about is the contract, because a P3 is a contract.
Right.
And it's like you sit down, you're in the city, you're the mayor or whatever, and you sit down with your group and you say, what do we want them to do? What do we want out of this deal? And, you have to write it down. You sit down with your lawyers and you have to put it in legal language, and it forces you to think about innovative ways of doing exactly that.
Right.
So what you said could be a great way to incentivize the company to encourage
Right.
conservation,
Right.
right? You don't have to use
Because
the
you
real
build a
toll.
water tower and then you're expanding the number of homes and you're not gonna have
Yeah.
enough pressure. You're gonna have to build another water tower.
Yeah.
But then you could say, no, what if we get everybody to reduce their water by 20%, then we don't have to
No, I
build a
mean,
new
it-
tower.
This, I know it's a
Yeah.
footnote, but this is a side thing with me.
Yeah.
I'm infuriated by the fact that our electric meter is on the outside of the house.
Yeah,
Because I can't tell I
yeah,
can't tell
how much you're.
when we should conserve.
Yeah,
When is the system at close to, peak?
right,
Well, we will not run the dishwasher,
Right.
the, you know what I mean?
yeah.
We'll conserve. But I can't even see it because, the electric utility doesn't give me any signal
Right,
about when electricity is scarce.
yeah,
And I think that's a mess up in the incentives, frankly.
yeah.
And I think we could adjust that. But Brian, did you have a?
I was gonna say, what do you think about Ithaca, where their Commons project, where they had a bid out for tender, there was only one bid.
I don't,
So
one
they-
bid bothers me.
They're redoing the Commons there.
Yeah, I know that.
Their project ran over budget, and the reason why it ran over budget is because there was only one proposal.
Oh, really?
And it just happened to be more expensive than they wanted.
Yeah,
I mean, I'm sure there's a lot of details for that, just throwing it
Well,
out there,
you know,
that can happen.
that's an issue, is how many bidders, how many companies can actually do this?
Right.
I mean, how competitive is the market really? Of course, as an economist,
You
I
want
like
to-
more competition rather than less, but, if there's only one giant company, that might be an issue, and you have to pay attention to that.
Yeah.
Encourage competition.
Thank you very much.
Thank you.